We will now talk about the principles of option pricing. We've seen payoff diagrams before, but since this is an important topic, I'll just go over this subject very quickly again. Let's first look at the payoff diagram for a call option. And we need to understand the payoff for both the long call as well as the short call. Take a very simple stock, which, let's say, as before, stock IFT, and let's say that you go long on this stock, and the call option that you have has a exercise price of 25. Exercise price or strike price, those terms are synonymous. With a payoff diagram, the x-axis represents the stock price and the y-axis represents the payoff. And if you recall, for a long call, the payoff looks like this, where the payoff is 0 as long as the stock price is between 0 and the strike price, and after that we have a linear curve or a line like this. So if the stock price is $1 more than the strike price, say 26, then the payoff is $1, and so on. So this is the payoff for a long call. Now what about the payoff for a short call? The short is sometimes also called the option writer. The payoff for the short call looks like this. So between 0 and the strike price, there we are essentially, the short is not making any payments, because if the price of the stock at expiry is 24, then obviously the long will not exercise the option, so the short does not need to make any payment. However, if the stock price at expiration is more than 25, then obviously the long needs to make a payment. So the payoff for the short call is simply the mirror image of the long call. Remember, this is a zero-sum game in the sense that when the long benefits, then the short loses out. So if at expiry the stock price is 28, that means that the payoff for the long is 3, and that payment has to be made by the short. So the payoff for the short is -3. So that's your long call and short call. What about a put option? A put option is one that gives the long party the right to sell. So a payoff for a long put looks like this. Again, let's say that the strike price is equal to 25. On the x-axis we have the stock price, on the y-axis we have the payoff. So the payoff for a short, this is a long put. So if the stock price goes down to 0, then the right to sell at 25 is extremely valuable, and the payoff will be 25. And obviously if the stock price at expiry is more than 25, let's say 26, then the right to sell for 25 is worthless. So if we are to the right of the strike price, then the payoff is 0. So this then is the payoff for the long put. What about the short put? Short put again would simply be a mirror image. So this is the short put. The maximum loss is 25, and obviously if the price of the stock at expiration of this put option is more than 25, then the long put will not exercise the option, and hence the short put does not need to make any payments. Now let's talk about the concept of market price of an option, intrinsic value and time value. The market price of an option is how much you would buy a given option for. I have referred to this before as the option premium. Sometimes we might just call this the value of an option. So the point is this. Let's say that we continue with our simplistic example where you buy a call option on IFT where the strike price is equal to 25. and let's say that this option expires in 2 months, and let's say that the current value or the premium on this option is equal to $3. So this means that in the market, this particular option, which gives the holder of the option the right to buy the underlying for $25, the value of that option is 3. So I'm using the term value or market price or premium all interchangeably. Now let's say that when the price of the call option is 3, let's say that the stock option is worth, let's say that the stock is worth $26. Now the concept of intrinsic value is that very simplistically, the intrinsic value is S minus X. So in our case, if the option were to be exercised today, the value of the option is 26 minus 25, which is equal to 1. So the intrinsic value of that option today is 1, and the time value is 2. Why is this the time value? Because we still have 2 more months before this option expires, and the reason this option is priced at $3 today is that the market is expecting or hoping that the stock price will go up further, and obviously if the stock price goes up further, then the holder of the call option will benefit. So due to that additional time and what can possibly happen to the stock during that time, that is what gives this additional value of 2, and this 2 is called the time value. So the basic relationship that you need to memorize is that the market price of an option at any given point in time is equal to the intrinsic value, which is stock price minus exercise price for a call option, plus the time value. This same relationship will hold for a put option, but obviously in a put option the formula for intrinsic value is slightly different. So for a put, the intrinsic value would be X minus S. Now let's talk about the lower and upper bounds on option prices, and from an exam perspective this is a very important topic. The first point to understand here is the terminology, and we will first consider call options. With a European call, the minimum price is represented by this expression, and it's easier than it looks. So let's understand the terminologies. To understand the terminology, let's just look at this picture. Let's say that this is our timeline. Time 0 is when the call option was issued. We are looking at time t, represented by small t, and ct, small c, small t, represents the value of the call option at time t. Big T represents the time when the option matures. And so the distance or the time between small t and big T is represented by this big T minus little t, and Ct is the value of the call option. St is the value of the underlying stock at time t. X, as you are already familiar with, is the exercise price, and RFR stands for the risk-free rate. So essentially what we are saying is that the value of the European call option at this time t is at least 0, and that's obvious because a call option is giving the holder an option, so it must be worth something. So the point of saying max 0 comma something is essentially saying that a call option cannot be worth less than 0. And then St minus X, so I'll just tell you a simplistic way of remembering this. So we are saying that this is essentially the value of a call option is St, the stock price, minus the exercise price. And this is the first level relationship. This also should remind you of the intrinsic value. And I am going to tie this with an example in the curriculum. Specifically, I'm looking at example 2 on page 107, where we are told that on a given call option we have a exercise price of 70. So X is equal to 70, and we are told that the option will expire in 42 days. So if the option expires in 42 days, then this t minus t is 42. In other words, this distance is 42 days. We are then told that we need to find the lower bound on a European call. So let's say that the underlying, so ST they have given us as 72. So ST is equal to 72. That means that at time t the underlying is trading at 72, and we need to find the lower bound on the European call option. So if we plug into this formula, what we are saying is ST is equal to 72. So 72 minus X is our strike price, which is given as 70, divided by 1 plus the risk-free rate. We are given that the risk-free rate is 4.5%, so we have 0.045, and then raised to the power of t minus t. Now this is expressed in years, so this will really be 42 divided by 365, and that is equal to 0.1151. So essentially we then raise this to the power of 0.1151. So it looks complicated, but is fairly simple. All we are saying is that the minimum value of a European call option will be denoted by this expression, and you just need to know what means what, so you can plug in the stock price, the strike price, the risk-free rate, and this is the time to maturity in years. And essentially when you do this calculation, you should get a value of 2.35. So that is the minimum bound on the value of a European call option with these numbers. The maximum value at time t is obviously the value of the stock. So what we are simply saying here is that nobody in their right mind will pay more than the stock price for a call option on that stock. Now this is a huge range, so essentially we are saying the range is between 2.35 and 72. Obviously that's not overly helpful, but nevertheless in level 2 we will figure out exactly what the value is. For now, as long as you understand how to calculate the minimum value, that is good enough. For American call, what you can just take as a given, first of all, the terminology for an American call is that instead of using small c, we use big C, and the lower bound is the same. So this is the lower bound for American call, and the maximum value again is ST. So simple thing to remember, the minimum value and maximum value for both European call and American call, we have the same formulas. Though one point should be obvious, these are just high level or simplistic ranges, but clearly the value of an American call should be greater than or equal to the value of a European call. And the reason is that with an American call you have more options. With a European call you can only exercise on the last day, and whereas if you have an American call, then you can exercise at any point. So that is why American call will be at least as valuable as a European call. Now the curriculum gives a whole lot of explanation behind this. I would just encourage you to memorize these formulas and to know the fact that an American option will be worth at least as much as a European. So as long as you memorize this, you are in good shape. Now what about put options? So here now you understand the terminology. So at time t, the minimum value of a European put is obviously 0. We can't have a put option. If you own a put option, that option has to have some value, so it can't be negative. And then you can essentially look at this other part of the expression, that where you now know all the terminology. So let me just write this out in a simpler way. So what we are saying there is X, which is the strike price, over 1 plus risk-free rate, so I'll just call that R for now, to the power of time remaining in years. So T minus T is the time remaining in years. If you have 6 months remaining, then this would be to the power of 0.5 minus ST, which represents the stock price at time T. This is the time at which you are doing the finding the value of the European put option. And the maximum value of a put option is equal to X. So X over 1 plus the risk-free rate to the power of time remaining. If time remaining is half a year, then you have 0.5. Very quickly, what's the intuition here? If you recall from an earlier discussion, the most that you can get from a put option is equal to X. So if you are talking about an American put option and you are at time 0, you have 0.5 years left to maturity, and let's say that the exercise price is equal to 25. This means that the absolute best you can hope is that at maturity the stock price goes down to 0, which means that you will get $25 out of this. But you can't but if the stock price even goes down to 0 right here, you cannot exercise the option here. For a put option, you have to wait till the last day. So if the best possible outcome on the last day is that you make $25, the value of that today has to be the present value of 25. So that's exactly what we are doing here. We are taking the strike price and figuring out or discounting it back to time 0, or actually time T. This is the time where we are valuing the put option. So this is the minimum possible value of a European put. This is the maximum possible value of a European put. With the American put, remember, we can exercise at any point. So the maximum possible value for an American put, which is denoted by a capital P, so the value of American put at time T, maximum possible value is X minus ST. So this is also simply the intrinsic value at a given point in time, and the maximum, this is the minimum value of an American put, and the maximum value is X. Why? Because even if before maturity the stock price goes down to 0, you can then exercise the put option, and the money that you will get will be equal to the strike price. So bottom line is that you simply need to memorize these relationships, and I'll just tell you an easy way of doing this. This is what I did. Unless you have a lot of time, I would not advise you to go and try and understand all the derivations, because I have never seen a problem that, at least on the CFA exam, that goes into the derivations. I have seen several problems that ask you to simply calculate the minimum value or the maximum value of one of these options. Now let's look at minimum value. So one point to note is that obviously the minimum value has to be more than 0. So that explains this part for all the relationships. And then for a European call or an American call, remember the simplistic relationship is the stock price minus X. So that you knew already. At least since a call option gives you the right to buy at X, then obviously a call option would be worth at least the stock price minus X. And then rather than simply taking X, we can do a little better by taking the present value of X. So you simply discount X at the risk-free rate, and obviously whatever time remaining to maturity, it is half a year, then you obviously need to discount for half a year. So it should be easy to remember S minus X, and remember for X we simply take the present value. And then the next point to remember is that we use the same relationship for both European and American. That is a simplification, because you do realize that the value of American option will be at least as much as the value of a European option. How much is that difference? That we do not need to get into. With a put option, the maximum value, the first simplistic thing to look at is simply x minus st, and here again, rather than just using x, you need to also discount x by dividing by 1 over r to the power of time remaining. Essentially, in 3 out of the 4 relationships, whenever you use x, you actually have to discount x. The only exception is the American put, because with the American put, if the stock price goes to 0, or at any point actually you can exercise an American put. So the quick thing that you need to remember is that out of these 4 expressions, the only place where we don't discount x is the American put. So you notice that with an American put, the x or the exercise price is not discounted here, and also with the maximum value, the x or the exercise price is not discounted. And just to repeat, since American options give you essentially more options, in other words, you can exercise anytime, then it has to be at least as valuable as European options, both for calls as well as for puts. Now let's look at the effect of a difference in exercise price. And a simple way to understand this is, let's say we have 2 call options, A and B. Both are on the same underlying. So in both cases, the underlying is, say, 1 share of IFT. And let's say that these options are similar in all respects. The same underlying, the same, let's say, both mature on 31st July. So maturity of both is 31st July. The only difference is in the exercise price. So A has an exercise price of 25 and B has an exercise price of 30. Which one is more valuable? And the answer obviously is A, because the right to buy at 25 is clearly more valuable than the right to buy at 30. So when we are talking about call options, then a higher exercise price, as we had for B, then the value of the call option will be lower. A put option will be the opposite, because a put option is the right to sell. So now if we have put option C and put option D, similar in all respects, the only difference being that on C we have an exercise price of 25, on D we have an exercise price of 30. The underlying is the same for both. Then clearly the right to sell at 30 is more valuable than the right to sell at 25. And so with the put option, if we have a higher exercise price as we have with option D, then the value will be higher. What is the difference, so effect of a difference in time to expiration? Now this effect is the same for calls and puts. Again, the simple way to look at it is take 2 options, A and B, and they are similar in all respects. So they have the same underlying, the same let's say strike price of 25 for both. The only difference is that A matures on 31st July and B matures on 31st August. So which is more valuable? Now the answer is B is more valuable, because with B, if this is a call option and you have bought option B, then there is more time for the stock price to go up, and hence there is a greater chance of your making more money with option B. Hence option B is more valuable. Going back to an earlier relationship that we talked about, the time value of B will clearly be more than the time value of A. And similarly, if this is a put option, you bought a put option because you are anticipating the stock price to go down, and if there is more time till maturity as we have with option B, then obviously the put option will be worth more for this situation. So put B is going to be more valuable than put A, because we have greater time to expiration. And this is the bottom line is right here for both call and put options. Longer time to expiration the more valuable the option. Now we'll talk about put-call parity, and this is also important from an exam perspective, and this actually you will see this at level 1, level 2 and level 3. So the CFA Institute obviously thinks that this is important. To understand put-call parity, we essentially need to create two simple little portfolios. One is called a protective put, the other is called a fiduciary call. A protective put is simply a share of a stock, let's say we call the stock S, and a put option on that stock, so we call that a P. Now the put option on a stock needs to, so obviously there's an exercise price, and we say that that exercise price is X. So a protective put is a share of a stock plus a put option on that stock where the exercise price is X. The second portfolio is a fiduciary call, which is a zero coupon bond paying X at maturity, and a call option with a exercise price of X. So in very simple terms, if we are here at time 0, and let's say that this we have 0.5 years to maturity, the X simply means that, or actually this zero coupon bond paying X at maturity means that in our fiduciary call, one of our assets or one of our investments here is a zero coupon bond which matures after 0.5 years, and at maturity it will pay us X. We also have a call with an exercise price of X, so this call option needs to mature over here. So it will expire over here, and the exercise price is X. All the options that we are talking about here are European options. And here is the relationship that you need to memorize. The relationship is that the protective put is equal to the fiduciary call, and we'll prove this on the next page, but from an exam perspective you just need to memorize this. So the protective put is the stock plus a put option on the stock. So we are long the put and long the stock. A positive sign means that we are long. So a protective put is equal to a fiduciary call, which is equal to the call option, plus at time 0, what is the value of this zero coupon bond? It is simply the discounted value of X. So X over 1 plus the risk-free rate to the power of time remaining, which in my simple example is 0.5. Let us now see how this relationship can be derived. So first let's look at our fiduciary call. So in a fiduciary call we buy a call and we also buy the zero coupon bond. What's the current value of the call? Let's say that the current value of the call is C0. So at time 0 the call is C0. And what's the current value of the bond? It's X over 1 plus R to the power of T, where T stands for the time in years remaining between now and the maturity of this zero coupon bond. So this is our fiduciary call at time 0, which is our current time. Now what about the at expiration? So at expiration there are two possible scenarios. One scenario is that the stock price at time t, and just the convention being used here is this is maturity, so time t, and 0 represents the current time. So at time t it is possible that the stock price will be less than the exercise price. So for a call option, if the stock price is less than the exercise price, then the call option ends up out of the money, so the value is 0. On the other hand, if the stock price is greater than exercise price, then the value of the call option at expiry will be ST minus X. What about the bond? So the current value is this. At expiry, the value of this zero coupon bond is simply going to be X, so by definition. So what is the total value of this fiduciary call? So this, remember, was the fiduciary call. So the total value of the fiduciary call at time 0 is simply C naught plus X over 1 plus R to the power of T. The stock price over here, so the total value, assuming that the stock price ends up less than X, or less than strike price, so this is simply equal to X. And in this situation, if the stock price ends up greater than the strike price, then the total value of the fiduciary call at expiration is going to be ST. So this shows our value at expiration. Now what about a protective put? So now let's talk about a protective put. What is the transaction for a protective put? We obviously buy a put option and we also buy the underlying asset. So we buy the stock at time 0. So what is the current value? The value of the put is denoted by P naught and the value of the stock is denoted by S naught. Now at maturity, what do we have? At maturity, one scenario is that the stock price at time T will be less than expiration. So in this case, what is the value of the put option? The value of the put option will be X minus ST. So the put option will be in the money. The other scenario is that the stock price is going to be greater than the strike price. So what's the value of the put option? The put option then is out of the money, so that's 0. The value of the stock at time T is just ST. So what's the total value of the protective put? The total value is either equal to X or it's equal to ST. So notice now that no matter what happens at expiry, the value of the fiduciary call and the protective put is the same. So in the scenario where stock price ends up being less than strike price, both the fiduciary call and the protective put will have a value of X, and if the stock price ends up being greater than strike, then both the fiduciary call and the protective put have a value of ST. So that essentially proves the relationship that a fiduciary call, which is represented by this, is equal to a protective put, which is represented by P naught plus S naught. And to help you memorize, I will write this again. Remember, so we are saying that protective put is equal to fiduciary call. So protective put is P naught plus S naught is equal to our fiduciary call, which is C naught plus X over 1 plus R to the power of T, where T is the time remaining in years. You need to memorize this relationship. So even if you can't reproduce this whole example, that's alright, but you must be able to reproduce this equation. Now, what is the concept of synthetic options and arbitrage? So I'll explain this point in simple terms, and then I want you to do the questions in the curriculum to truly understand this. But I'll start by again writing that equation. So protective put is equal to fiduciary call. The protective put is P naught plus S naught is equal to the fiduciary call, which is C naught plus X over 1 plus R to the power of T. Now whenever you have a positive sign, this simply means that you are long in that position. So based on this, what we can do is create something called a synthetic option. So a synthetic put option, for example, can be created by saying that we have a call option plus the 0 coupon bond and minus S naught. So we've simply taken this equation and used some simple algebra to move S naught to the right side, and when we move S0 to the right side of this equal to sign, it becomes negative. What does negative mean? Negative means that we are short the stock. So what this is simply saying is we can create a synthetic put by going long on a call option, long on a zero coupon bond, and short on the underlying stock. Similarly, we can create a synthetic call option by going long on a put, long on the stock, and short on the zero coupon bond. We can also create a synthetic stock, and so on. All you need to remember is to create this synthetic instrument, we simply play around with this equation, and a positive sign means that we are long in that item, a negative sign means that we are short. Now, where does arbitrage come in? The idea is simple. If we have a situation where the market price of a call option is say 3.00, and we can create this synthetic option by doing this, and let's say that the value of the synthetic option, when we go long the put, long the stock, and short this bond, let's say that this is giving us 3.05. So this means that there is a arbitrage opportunity. When there is arbitrage, you buy low and sell high. So effectively what you can then do is buy the call option in the market, and then essentially you sell this synthetic call option. That's fundamentally what you need to know at this stage. Finally, what are some other effects that you need to know? What is the effect of cash flows on an underlying asset? And what I mean by this is the following. So let's say you have your call option, so call option C. The underlying is a stock, IFT, and this stock, let's say, is a dividend paying stock. So this stock, let's say, is giving you a healthy dividend. What's the impact on the call option if the underlying has a cash flow? So the dividend obviously is a cash flow. This cash flow is being made while the call option still has not been exercised. So if there is this dividend, what's the impact on the value of a call option? And the answer is a call option is less valuable. We don't need to go into the details, but the intuition is as following. When you hold a call option on a given stock, the cash flow, you don't really own the stock, you simply have the option to buy the stock. Now if the stock suddenly decides to give a high dividend, owning the call option is less valuable. In other words, it might make more sense for you to exercise the call option and get a hold of the stock so that you can get the dividend. So in simple terms, when a stock is paying dividends, that makes the call option less valuable, and the put option, however, becomes more valuable. So just memorize that. When the underlying pays a dividend or the underlying has some cash flow, the call option becomes less valuable and the put option becomes more valuable. What happens to the option? Let's take again a call option. If the underlying becomes more volatile, the way you can think of this is, if the underlying initially is not very volatile, then for some reason becomes very volatile, so the stock price starts changing a lot. Higher volatility is good for the call option. Why? Because in a call option you make money if the stock price goes above a certain strike. If the underlying is more volatile, then the probability of making money through this call option becomes higher, and therefore the call option is more valuable. What if you hold a put option? There again, with a put option you make money when the stock price goes below the exercise price, and if the stock is more volatile or the underlying is more volatile, the probability of making money from the put option is more, and hence the put option is more valuable if the underlying is more volatile. And finally, what's the impact on option value if interest rates change? and the simple way to, I'd suggest you just memorize this. If interest rates go up, then the call option becomes more valuable and a put option becomes less valuable. If you insist on understanding the logic, one simple way of looking at this is as follows. If interest rates go up, then let's say you believe that IFT stocks are going to do well. If interest rates are high, then essentially by buying call options on IFT rather than actually spending money and buying the stock, by buying call options you still have managed to get a positive exposure to IFT, and the money that you have saved by buying call options rather than buying the stock, that you can invest at a higher interest rate, and that obviously is beneficial. So whether or not you understood that doesn't really matter. What you must just memorize is that if interest rates go up, then call options become more valuable and put options become less valuable. So that is it. As always, practice real hard. There are several problems in the curriculum. You should do them all, whether they are multiple choice or not, and post your comments please if you have any. And if you like this video, then click on the like button.